Good evening, guys. Shall we start the session? Okay, welcome to you for the financial management and financial management session. Today, we are going to have some discussion about your pre-scene and related concepts and background study about financial management and risk concerns we will discuss in this session. Right. Hope you have already gone through a few times in the pre-scene. It's a long pre-scene you have to go through, and it start with uh, prime grow, then OV, Oliver Wyman, then it has moved to milk bloom. Right. In order to discuss in this area, first we need to look at what we need to do and what are the areas will be checked and what kind of questions you need to answer, and you might have seen the past experience if you have previously sat for the exam. Therefore, you need to understand what areas will be checked in the final examination. Then I will give you a background idea about what are the areas you need to have an idea and what kind of things you might need to be prepared for. Right, I will share the presentation. And time I will go to the pre-scene as well. Now, corporate finance and risk management aspect, I will cover up the risk management aspect as well. And when we are going to discuss about corporate finance management, how are we going to manage and how we will analyze the financial implication on the given information. And throughout the session also, I will discuss some additional information related to the governance, even though it is not necessary, not required to do, but I will cover up that as well. Right. In the financial management, what are the areas which you need to know? Right. There are three sections in this syllabus. It cover up 20% or 20 marks will be given in this area. In the overall syllabus contain 100%, 20%, 20 marks goes to the assignment. It is already done. That's why you have proceeded to the next level. Then financial management, 20% weightage is there. Right. Look at the first section A. What we need to do? Section 1A. Evaluation of financial feasibility of the project considering its financial indications. Sometimes you might have been given some situation to acquisition, merger, sometime new business venture, new business you are going to start. Then you need to evaluate in financial perspective. You need to evaluate and you need to decide whether it is suitable or not. In the last examination also, you can go and see they have given a forecast for 10 years. And you have to work out the expected value and you have to work out the value of the arrangement. And you need to say which is suitable, whether this investment is suitable based on the valuation. Therefore, you will use different alternative valuation method. Today, we will discuss different valuation methods and technique. How are we going to deal with that? Right. Therefore, whether the project is feasible with alternative valuation method like net asset basis, free cash flow basis valuation. Likewise, we need to look at. Then, you once you have done, you have to see the financial feasibility of the option. Right. Then, thirdly, we have to look at about scenario analysis. If this kind of situation happen, what will happen to the project feasibility? Right. Qualitative. What are the qualitative factors? What would be the cost of funds? What is the return on capital employed? What is the return they will expect? We need to work out during this analysis. Then once we are going to analyze the available options, then you need to decide what should be the feasible, proposed, best suitable funding strategy. You will evaluate the option, then you will look at what is the suitable funding arrangement, whether equity-based financing or debt financing, whether mixed financing, both composition of equity and debt. If you are a listed company, are you going for a right issue, right? You are going for a listed debenture, or you are going for a bank loan. You have to decide based on the capital structure. We need to decide for that, right? that is there. Therefore, if it is a unlisted company, if you are not listed company, then what are the available options for equity? What is the available option for debt? Now, if you are a private limited company, you can go for an IPO, right? Then you have to evaluate if this is a suitable situation to go for an IPO. Is this a suitable time to raise funds via borrowings? That conditions you need to evaluate properly, and you need to see what kind of option is suitable, right? Therefore, thirdly, we have the second option, third category, we have to advise on the risk management of the company. There might be different kind of risk will be there. How are you going to identify those risks? How are you going to evaluate those risks, risk assessment? And what are the mitigation factor? How are you going to mitigate it and control it? And risk reporting and evaluating those entire risk management process you need to go through. In a business, when you're operating in a dairy industry, what kind of risk you might have to go through, that you need to evaluate. Those are the areas which you need to look at. In overall aspect, you have to see in the pre-scene what kind of areas will be there. Clear? Right, okay. As I have mentioned, the most important aspect in this one is the capital budgeting. You have to look at this investment option, investment appraisal in different perspective, and most of the time you have to evaluate the present value of future cash flows, and you need to determine uh, project NPV or the given option. You will anyway, when you're going to do a business valuation, you have to discount future cash flow basis valuation will be there. Last year also the net profit is given, you have to do some adjustment and you have to get the cash flow and do the valuation. Therefore, a payback period, one exam I can remember 2017, they asked to work out payback period. They will undertake the investment if their payback period is less than 4 years. Then you have to, those are the concepts, those are the things they have checked. You have to work out whether they will give the net profit of the project. Then you have to make working around how to calculate payback period. They said that payback period should be 4 years, less than 4 years, right? Then discounted payback period, net present value is a very regular method we are using. And accounting rate of return, you can generally, we will calculate return on equity, we can calculate. And internal rate of return, IRR, we project where the project NPV is equal to 0, and profitability index when we are going to make different investment and different capital employed. Project size is different, then you have to calculate profitability index. And some situation when the project period is different, you have to calculate annualized NPV to make the decision, right? These are the explanation about payback period. Payback period means how long it will take to recover your initial investment. You will select the project which you can initially or immediately which you can recover. Net present value, that means you will look at present value of total receipt versus present value of total payments. Net present value. If it is present value of receipt is higher than present value of payments, then it is a positive NPV, and you will decide highest in project which has highest NPV, positive NPV will be selected subject to project are mutual exclusive project. You would select the highest NPV subject to if it is exceed the target NPV. If some situation there, they will give the target NPV. Accounting rate of return, you will calculate net profit divided by average investment. That is how we will calculate accounting rate of return. It is a subjective measure because it is not counted for the time value of money. Accounting estimates will be there due to the use of accounting profit, that we need to keep in mind. Then internal rate of return, that is the maximum cost of borrowing rate which you can borrow, because you must maximum cost of capital rate. If your cost of capital rate is greater than that amount, that your NP will be negative. The maximum cost of capital rate will be given in the internal rate of return. IRR. Profitability index, when the initial investment is different, then you have to calculate profitability index while dividing the net NPV divided by the initial investment. NPV plus initial investment divided by initial investment. Those are some techniques in capital budgeting which you need to aware, which you have already learned in financial management as well. Use of terminal value in most of cases. What will happen? They will given the cash flows. You have to adjust the cash flows for 5 years. Some situation they will give the information. These are the cash flows or profit for 5 years. Then it will say the cash flows after 5th year will be grown by 3% or 5% over future period. That means that indicates that you need to calculate the terminal value beyond 5th year to the uncertain infinity. We have to work it out. In order to do that calculation, you have to work out this terminal value calculation. You will, this similar model, the terminal value here, if it is a growth rate is there, the dividend valuation, dividend growth model will be used to determine the terminal value of the, here it is free cash flow, right? Then free cash flow into 1 plus G, that is in dividend growth model, it will be D0 into 1 plus G divided by weighted average cost of capital minus G. Why I have taken, if you have taken cost of equity and debt both together as a source of funding, then you have to take the weighted average cost of capital, right? Based on that, you have to calculate the terminal value, right? Hope you have understood this calculation, the concept. Then, as I have mentioned earlier, you have two financing options, either equity or either debt. If you are a private limited company, you can go private equity funds or private placement, or you can list your shares via an IPO. Or you can, if you want further cash requirement for finance a project, you can go for a right issue if you are already being listed entity. Then debt financing, you can obtain bank loan, debentures, instead of private and other debt instruments such as commercial papers, right? Those are financing strategies. When you're going to select financing strategy, you need to decide whether which financing strategy is more suitable. Because some companies, if they have already geared, that means they are already leveraged. That means their debt is much higher than their equity. And if they are facing some issues, banks are not willing to lend more. If they are a high gearing company, then debt financing will not be suitable. Therefore, when you are going to evaluate debt and equity, you have to compare you had to evaluate the gearing situation of the company. After evaluating gearing situation of the company, you need to decide which whether you need to finance to debt or equity. Therefore, you have to see whether which option is suitable. If it is an equity financing option, I am telling you can note it down wherever it's relevant. If it is an equity option, you have some positive signs as well, negative signs. Positive signs are there. One is, if it is equity raising option arrangement, existing shareholders control ownership won't be, if it's equity option, what will happen? You can raise, there's no fixed commitment because equity shares no repayment back. There's no repayment of any interest, right? Therefore, you don't have any repayment commitment, right? Therefore, you can raise the capital and put into the business. That is the main, because there is no fixed commitment for that. The disadvantage of equity is, theoretically, it is the high cost option. Why it is high cost option? Because the equity holders entitled for the residual value of the entity. Since they are entitled for residual value of the entity, you need to expect. Since they are bearing high risk, they will expect high return, high risk and high return. That is that is the main concern. On the other hand, when you have issued right issue, sometimes earning per share will dilute with number of shares are going up. Sometimes automatically, when you write issues, the promoter shareholders have not been subscribed, automatically control of the entity might have passed to some other entity or some other person. That can happen, even though you don't have any fixed commitment. Then, if it is come to a debt option, you can easily raise it, right? But there's a fixed commitment to repay the loan and interest. And promoter shareholders' ownership won't dilute, but since you have a commitment, if you are not performing well, you have to bear the high risk. You have to bear at finance cost, and sometimes you might face some liquidity problem when you may not be able to service your debt. Right. The operational flexibility will be lower. Bank will put some covenants. You can't do this. You have to do this. Likewise, and bank may put some restrictions on your operation. That we need to keep in mind. Therefore, there are some pros and cons you need to weigh on that, and you need to decide what kind of structure need to be taken place and what kind of structure you need to suggest, which is mutually beneficial to the organization and run to run the operation. Therefore, you have the right to determine which option to be selected, right? Either debt or either equity. You need to decide on that. Right? I am recalling the things which you have already learned, and you have to get an update on this. Thereafter, later I will relate it to the pre-scene and we will discuss in detail. Cost of capital. When you are going to determine the cost of capital, sometimes the way you are going to source the funds, either equity or debt. If we look at about equity, the cost of capital has three options. Risk-free rate will be there, premium for business risk and premium for financial risk will be there. When we are going to calculate the cost of capital, the cost of equity and cost of debt, you need to evaluate and work out. When there's a high risk and investors expect higher required rate of return, right? Therefore, they expect higher required rate of return, your cost of capital will go up, right? Actual returns may not be the same as high as expected to be, then there's a high risk because they will expect of a premium of the business risk. The other extent, some situation, there's a risk that they will not be able to achieve the desired target. Business condition can be go wrong. Under such situation, required rate of return of the investors will go up. Right. And premium for financial risk and equity holders, if they invest, they are not entitled for a guaranteed return. Due to that variability of the return, they will expect higher return. That's why cost of equity much higher than the cost of debt. When we evaluating cost of equity, you might have already learned about cost of equity. Here it is cost of equity equal to risk-free rate plus beta, that is systematic risk, into market risk minus risk-free rate. That means here it is the risk premium. Then you will determine what is the cost of equity based on capital asset pricing model. Some examination, it has been given directly. Then you have to work out what is the applicable cost of equity rate. Here, there's an example I have given. ABC company have a beta of 1.5 times, and the expected market returns to the market are 10%, and the risk-free rate of return is 4%. Cost of equity, you can easily work it out. Cost of equity, AE, equal to risk-free rate is 4% plus Beta factor is 1.5 times. Into market rate is given how much? Market rate is 10%. Right, 10% minus risk-free rate 4%. Then simply it is 4% plus 1.5 into 6%, that is 9%. Together, then cost of equity will be 13. Right, cost of equity will be 13%. That's how it will work out. Capital asset pricing model, this similar kind of illustration, examination, it was there in past papers, you can see, and how we are going to determine cost of equity. Therefore, capital asset pricing model, when you are determining cost of equity, it includes risk-free rate plus beta into risk premium. Right. Okay. Second. Right. Now, geared beta and ungeared beta, we need to discuss. In the geared beta and ungeared beta, we call levered beta as equity beta, and unlevered beta we call asset beta. This is how the computation of capital is based on the capital structure. You have to determine the leverage, the beta you have to determine, right? Levered beta is a function of ungeared beta into equity plus debt divided by equity. Here, B into 1 minus T means that you have adjust for the tax shield. In the tax rate, you need to adjust to determine the tax shield of the entity. Then you can determine the levered beta. Unlevered beta, you can see beta unlevered equity divided by debt plus equity. Levered beta into equity divided by debt plus equity. If we ignore the tax, levered beta equal unlevered beta into equity plus debt divided by equity, right? You can this is some information will be given in financial management FM paper. You might have already done similar kind of illustration. Sometime a company you are going to in a target acquisition, it is a private limited company. Then those private limited company, you need to determine the enterprise value. When you're going to determine the enterprise value, similar entity value, comparable entity values will be given, their beta factor and their gearing ratio will be given. Then what you have to do, you have to use that levered beta and unlevered, and based on the capital structure of the target company, you have to re-gear and you have to calculate geared beta. That's how it will work, right? That kind of situation will be there, then you have to prepare for that and you have to work out how to deal with this levered beta and unlevered beta. Right. The next one is very important one. You can ratio analysis, the ratios which is important for your examination, financial information also provided, and you can work out the ratios, and based on those ratios, you can make some decisions which and some indications will be given, and based on that you can make proper analysis over the company's performance. Now, profitability ratios in this explain return on capital employed, profit before interest and tax, PBIT, divided by capital employed. That means profit from operation divided by total asset less current liabilities. Then you will get the capital employed, total asset minus current liabilities. Return on equity, profit after interest and tax, and book value of shareholder funds you can take, stated capital plus retained earnings. Profit margin, PBIT divided by sales. Sometime you can take profit after tax and divide by into sales. You can get the net profit margin. GP margin, you already know, gross profit divided by sales, and return on capital employed, asset turnover ratio divided by profit margin. Those are the ratios which you have already have an idea about. Profitability ratios. In this illustration also you can work out those ratios, right? Hope you have understood that. Then right, next one, DuPont model based on some information which you have already provided. You can calculate return on investment, right? Return on investment. How to the in DuPont model will help you to determine that return on investment ROI. When you're going to determine return on investment, you can see how it has been determined. Current assets and fixed asset, you can calculate. Sales divided by total asset turnover, you can easily work out. In this illustration also, this pre-scene also, you can determine sales divided by total asset turnover, you can easily calculate. I am just guiding you to do the calculation. Then you can calculate asset turnover. Then you will able to calculate profit margin. Here it is sales or turnover minus operating expenses and non-operating income you can add. Then earning before interest and tax, EBITD. Sorry, EBIT, earning before interest tax. Then divide by sales. Then you will get the profit margin. Then if you multiply asset turnover by profit margin, then you can take return on investment. Now you can calculate, because the financial information provided for Milk Bloom, you have those information. 2-year balance sheet statement of financial position being provided and 4-year profit loss statement being provided. But you can't work out all 4 years. You can work out for 2023 and 24. If you work out asset turnover and profit margin ratio, net profit margin before PB, before interest and tax, then you can calculate what is the return on investment they have made over last 2 years, whether it is improved or it has been diluted. You can work out. You can see. Then gearing ratio is very important when you are determining gearing ratio. Why I'm saying this is more important? Depend on the gearing ratio, you will determine the funding. You have to determine the funding strategy. Either go for debt or either go for equity, or whether you are going to maintain same capital structure if it is healthier. Now, first we look at debt ratio, total current and non-current liabilities divided by current and non-current assets. Then if it is greater than 50%, that is high gearing. Or you can work out debt to equity ratio, interest bearing net debts and shareholder. If it is greater than 100%, it is high gearing. In this company, if you work out that one, it is less than 100. It's moderate level. Value of debt divided by value of equity, then you can decide if it is greater than 100% or greater than 1. Then it definitely is high gearing situation. Right. If it is high gearing situation, definitely you may not go for probably you may not go for debt financing. It is high risk and your flexibility in operation will be diluted, and profitability also affected if you are in a high gearing situation, if you further increase the gearing. Right. Operating leverage, contribute sales minus variable cost divided by profit before interest and tax. Then you can look at what is the high reliance on, whether you are highly reliant on variable cost or fixed cost. If you have invested in high fixed cost, you can look at the operating leverage. Then if the ratio is lower, that means your overhead cost is much higher. Contribution is sales minus variable cost. But PBIT, it includes fixed cost as well, right? Then you can determine whether it is higher gearing or lower gearing. Interest cover, whether do you have sufficient amount of profit or to pay your interest payment, right? Operating profit will be divided by interest cost or interest payable. Generally, it will be taken profit before interest and tax, and then you will divide it, will be divided by interest payable. Liquidity ratio is very important in assessing liquidity, profitability, liquidity, and gearing is very important. First thing is you have to look at about the current ratio, and some information will be given in the industry as well. You have to look at whether liquidity is improving or whether you are in par with the industry average. When you maintain high liquidity, there's a consequence in working capital management. If you keep high liquidity, that means you are very conservative. You want to maintain the liquidity, but on the other hand, you have to sacrifice the profitability. Some situation, you will maintain lower liquidity, and then that means you are looking at higher profitability, but you will face liquid issues in short term. Therefore, it needs to be balanced properly, because in the working capital management, proper management of current asset and current liability, or working capital management and liquidity and profitability management is very important. If you maintain high liquidity, your profitability will be sacrificed, but you will achieve liquidity targets. If you lower gearing situation, low liquidity situation, you have sacrificed liquidity and it can disrupt the operation, but you can achieve a higher target, higher profitability, less unproductive assets. Because if you keep cash as it is unproductive, right? Therefore, we have to maintain proper debt to equity ratio. And quick ratio is current asset minus inventory. Sometimes you will inventory plus prepayment will be removed. That means you will look at the most liquid assets and divide by current liability. In order to settle 1 rupee worth of current liability, it should be general norm. It should be there 1 rupee worth of current assets, almost liquid assets. Now you can work out those ratios in relation to the milk bloom, whether their current ratio has improved, whether it is reasonable, whether their quick ratio is reasonable. Then receivables collection period, trade data collection period, trade receivable divided by credit sales into 365. But here, generally, you in this situation, you won't sell on credit, right? We have to see, and then you will determine that, because you can't assume that all sales are on credit because it is not been splitted. Payment period, trade payables divide by purchases into 365. Those information not available as I have seen in the pre-scene. But inventory holding period you can look at. Now the milk bloom, when we come to the milk bloom, they are manufacturing dairy products. They are holding a stock. You can see how fast their inventory turn into sales. If they are having a higher inventory turnover, that's good. If it is a lower inventory turnover, inventory holding period mean a higher inventory holding period mean it's not good for the business. Then you can see whether their inventory holding period improved or not. Based on that, you can decide what are the things you need to do in the working capital cycle, right? Cash operating cycle, in order to determine the cash operating cycle, that means how long your entity will be run out of cash. That means Once you take the raw material and once you may convert into finished good, and finished good convert into sales, and sales will be in debtors, pay my receivable, sellers, they need to sell on credit, and then one until the customers are paid, how long you will need to wait? During that period, you have to pay your supplies. Therefore, you have to work out what is the period you are run out of cash. If it's longer the period, not good for the organization. If it's shorter, then it is more suitable. Your working capital requirement will be less or very minimal. That is relevant to most of the time. This is relevant to your working capital management in this pre-seed scenario. Working capital management aspect mainly you can consider only inventory days, current asset, and quick ratio. You can work out, right? Then you can analyze those ratio analysis and keep it done. Then you can get an idea how the things are moving. You can work out and see based on the working capital ratio and this mainly current ratio, quick ratio, and inventory days. You can work out and see whether this is suitable and then any improvements to be done and what kind of areas you can see, right? Or the investor ratios, very important in this aspect in the valuation point. Why I'm telling these are valuation techniques, earning based valuations when we are carrying out. These valuation techniques or these investor ratios will be much helpful. I'll take an example. Here it is given PE, price earning ratio. Now, price earning ratio is market price per share into earning per share, right? Uh, when it going to calculate, now I think you have already read, while assuming that you have already read the pre-scene, have you read the incident, the section related to uh, Frostbite Bar, the ice cream company? Because now it's kind of always now, even I am go for a sleep, still I can remember different things and Frostbite Bar and uh, MB Cow Project. Those are the things these days my head is working on. Right. Now PE ratio. Now this Frostbite Bar, they are doing uh, market earning is 71 million BDT, and there's a transaction they have discussed with MB, and the market multiple they said that 6 to 9.5. Then under such situation, 6 to 9 point, that is the PE ratio, price earning ratio, 6 to 9.5. If assume your market PE ratio, price earning ratio is 6 times, then how you determine, because it is market price is not readily available, then how to determine the market price? You have the earning per share or earnings, you have EBITDA, earning before interest, tax, depreciation, amortization, then multiplied by PE ratio. Then you can get the market value of the entity, market price. Market price can be determined. Because now while you have reading, there are so much of implication. I am just giving some insights and just plugging here and there. Then you need to remember, because those you at least at this moment you need to read this entire briefing by 2-3 times minimum. If I was an student, at least I have read it more than 7-8 times until I get the entire scenario. And there might be while doing the first reading, you don't have any clue. In second reading, you might get some clues and you will highlight. Third, fourth, and fifth, when it comes to the fifth time, you will know while reading in the fifth time, there will be new perspectives and new uh, implication will be pop out, right? Yeah, some people have worked out the calculation and you can see, we will look at later, right? You can work out because there are some information available. And dividend yield, dividend per share divided by market price per share, then you can look at the dividend yield. In this situation, you can Milk Bloom PLC also, you can look at the dividend yield. They have paid recent financial year 2024, as I can remember. They have paid to BDT, Bangladesh Taka per share, right? For Bangladesh Taka, market price was around 49.5 BDT. Then you can see at least what is the uh, dividend yield. Approximately, it is close to 4% yield. Then compare whether it is a suitable investment or what kind of earnings you can expect. 4% return on equity. Sorry, based on dividend yield, right? Market price and the dividend per share, you can work out. Price earning ratio, you can work out market price per share divided by earning per share. When it comes to the Milk Bloom, I will show you how it should work out. What kind of PE ratio is their price earning ratio? How many times it will take to recover your market price? As an example, assume your earning per share is 5 rupee and market price is 25. That means it will be 5 times. 25 divided by 5. Assume that the 5 rupee per share is the annual earning. If you expect to continue, it will take 5 years to recover your market price, right? Based price earning ratio. That is called market multiple. Earning per share, profit distributed to the ordinary shareholder divided by number of ordinary shares issued. In this illustration also, they haven't given the number of shares issued, but you can work out into the nearest, because earning per share given and earning for the period also available. Then earning yield, earning per share as a percentage of market price per share, earning per share. As I can remember, your earning per share, a Milk Bloom earning per share was 2 rupees and 69 cents. And share price as at April 1st, April 2024 was 49.5, as I can remember. 49.5, right? Then if you divide 269 by 49.5, it is average 5.4% return, right? It is 5.4% return. Then earning per share, dividend cover also, earning per share divided by dividend per share, you can see how much they have paid. 2 rupees paid in 2024 out of 2 rupees and 69 cents. That means 74% paid as a dividend from the earning, right? That dividend payout ratio will be 74%. Then dividend cover, if you look at earning per share, 2 rupees and 69 cents, 2 rupees and 69 divided by dividend per share, it is 1.345. 1.3. Yeah, 49 rupees and 50 cents. Return on shareholders fund, then net profit divided by shareholder funds, then you can get what is the return on equity. Return on equity. These investor ratios and very important, net asset per share, you can divide net asset divided by number of shares, then you can calculate net asset per share. Right, different investor ratios which you may concern. Based on the given information, only financial information provided for Milk Bloom PLC. Then we have to work out these ratios for Milk Bloom PLC, and there is a way to work out some information, financial information relevant to uh, Frost Bite Bath, and some consideration you have to pay on there will be potential acquisition in Milk Bite Bath. Then what you can do, what you want to analyze, right? Right. Modes of business valuation. What are the methods? What kind of regularly being tested methods there are in your valuation of a business? If it is an acquisition, merger, or startup of a new venture, there are some valuation methods. First one, net asset basis valuation. Then PE based valuation is a earning based valuation technique, and dividend based valuation again earning based valuation, and cash flow based valuation we could call free cash flow basis valuation we can use. Those are 4 techniques. One by one we will discuss when we are going to determine the enterprise value. When we are going to do the valuation, the net asset basis valuation we call as the minimum enterprise value, minimum value. Because this net asset basis valuation may not reflect the future earning potentials. Therefore, this is a valuation which is based on historical information. Right. Therefore, this net asset basis valuation is more suitable when the company is not performing well and do not have future prospects, and the entity is recently established. Then it is suitable to use net assets basis valuation. If company has continuously suffering losses and company has lost the market share and the trust of the consumer or customers, then under such situation, the minimum price need to be determined, and net asset basis valuation will be required. Right. Okay. And the net asset value highly depend on the assumption used in valuation of property. The changes in PP value significantly affect the value of enterprise. Right. When we are going to do the net asset basis valuation, it says that you have to exclude intangible assets. When you are going to those intangible assets, there are some exceptions. When it is an intangible asset, the monetary value can be measured reliably, and it can be separable and separately identifiable, like royalty and rare kind of patent right. They can be separately identifiable, and their economic benefit can be measured reliably. Those should not be excluded. Goodwill, which you can't recognize separately identifiable, that you need to exclude when you are doing the net asset basis valuation, right? Therefore, most of the time, this net asset basis valuation mostly tied up with the tangible assets, right? Therefore, mostly property, plant, and equipment and inventory, those tangible asset will be, if it is a manufacturing organization, most of the asset value reflect in the tangible asset item. Remember, net asset basis valuation is the minimum value of the entity. Earning basis valuation, PE ratio. This is the highest business valuation is usually calculated by valuing the earning under new ownership, right? This method uses the price earning ratio, which shows the stock market's view of the growth prospect of a company. Price earning ratio. And when we are determining the value, there are some market multiples you can determine. Earning per share, in this situation, you can calculate earnings and PE ratio, PE multiple, then you can do the valuation of market capitalization. These valuation techniques mostly required for the entities which are not listed. Because if it is a listed entity, you can easily take the market value of the listed entity. But if the entity share is not regularly being traded, when it's going to an acquisition, the market price also may not be reflected correct price, right? Then at the time of doing major acquisition or major disposal, then separate valuation to be made. The recently you have an experience in the practical scenario, the big giant in Columbus Stock Exchange, Expo Holdings, their shares were delisted, right? At the time of uh, valuing the shares, it is around less amount, around 50-60 rupees is the net book value, but they have paid 185 rupees per share, right? Because under such situation, market price may not reflect the correct true value of the shares if it is uh, in a normal trading arrangement. Therefore, you need to do a separate valuation, sometime based on market multiples or price earning ratio. You have to estimate the enterprise value, right? Therefore, as I have mentioned, this is the maximum end, high end valuation is earning basis valuation. Price earning ratio into earning per share, then you can calculate market value per share. If it is total market capitalization, if you want to calculate PE ratio into total earnings, then you will get the market valuation or capitalization of the entity, right? Dividend growth model, as I have said earlier, if you have received continuously, if you have received the dividend, then you can calculate what is the growth rate. Sometimes growth rate might have been given. If it is not been given, you have to work out the growth rate. You have to take over the period what is the average growth rate of the dividend. Now, in this scenario, if you have read properly, Milk Bloom, right? Milk Bloom PLC paid 1.5 Bangladesh Taka over the period, right? Constantly paid 1.5 BDT. And this year, you have 2024, they have paid 2 Bangladesh Taka per share. But we can't expect same growth rate over the next period because their earnings have little bit diluted, and you can't expect. But if they wanted to maintain same growth rate or assume a reasonable growth rate, it might have been given. If it is not been given, because we are not supposed to do the valuation of Milk Bloom, I think. But if it asked, we can do different valuation, you can work out. Now, I will take an example for your consideration when we are going to do some valuation. Based on the recent reports or calculation available, return on equity you can calculate and you can determine shareholder required rate of return in 2024. Net profit divided by shareholders' equity, then it is around 8%. Based on the given information, if I work out dividend you have paid 2 rupee, you will expect 2 rupee over the period. Price of a share should be, but at the moment you have a price of the share 49 rupees and 50. Based on dividend growth model, they are paying a lower dividend, very low dividend, because their earnings are lower. Assume there's no growth rate. 2 rupees divided by cost of equity is 8%, there's no growth rate, and 2 divided by 8%. There's no growth rate at all. If you work out this one, you will end up with 25 rupees. It should be the market value of share. But at the moment, market value is 49 rupees and 50 cents, right? Then this value may not reflect the correct market. right? That is how you can calculate. Based on the information given, you can value if entity is continuously paying dividend, you can value the uh, entity's enterprise value based on dividend growth model, right? Then we will move to free cash flow basis valuation. Generally, in last examination also it has been given revenue minus operating cost. You have to plus depreciation, and if you have obtained a loan, you have to deduct debt repayment. Yes, can't we take 1.5 and 2 difference as a growth rate? But you can take it here, but can you explain continuous growth rate over a future period? Now, if I work out 1.5 into 2, right? What is the growth rate? That means 50 cents, 0.5 or 50 cents divided by 1.5. Then growth rate is 33.33. Can you expect 33% growth rate over the next period? That is the problem. That is the concern. If it is available, then this model 33% growth rate, cost of equity should be around 40-50%. Otherwise, the value will be abnormal. You may not be able to calculate. Therefore, you can't 33% growth rate here because it is an abnormal situation. Not that expected. You can't expect that growth rate over the period because there's no history of growth rate of 33% over the period. Right. You can read it in, you can, because if it is not been given, you can assume, you can make an assumption because that is not necessarily required for here, because the calculation you might not be able to work out because it's a listed entity. The dividend based valuation may not be required. If it is they have given the growth rate, anticipated growth, they will be provided in the examination. Most of the scenario, it has been provided. Or otherwise, if it is not there, then you can look at what is the industry growth rate, and industry growth rate you can insert into the because the pre-scene itself says that industry growth rate is 2 to 3%. Then if it is industry growth rate 2 to 3%, you can't expect 33% growth rate, because therefore it is abnormal. Therefore, under such we will assume percent growth rate, right? Now, again, I will do the calculation. We are expecting 3% growth rate. Therefore, P0 equal, your dividend is 2 rupee and you expect 3% growth at 1.03, 1 plus G. Divide by cost of equity, return on equity is 8% in 2024 minus 3%. Then if you work out this one, what is the value? Growth rate based on earning, 41 rupees and 20 cents. It's fairly trading at 49. There might be some premium will be there in the market prospect. That fairly you can assume like that. 41 rupees and 20 cents. The earning rates also you can use, but in the dividend growth rate, dividend growth, here you mean in this given information, the growth rate is not that extent. The cost of equity as 8% calculate. How I have calculated net profit divided by equity. If you look at about 2024 average, the ratio will be 8%. Less than the market value. Different valuation methods give you different valuation amounts. If you look at about net asset basis valuation, a different amount, right? Therefore, different valuation basis will be given different valuation. Therefore, market price, supply and demand value, market expectation. The value in the market may not be the value which we calculate based on dividend growth model or net free cash flow based valuation. It may not be same as the market price. It can change. It will change time to time. It will change depend on the market conditions. Free cash flow basis valuation, this is a very important thing. Here you will calculate the entity's ability, right? Ability to generate cash from its operation, free cash. Therefore, revenue minus operating cost, depreciation will be added back, repayment of lease obligation, and if you have to deduct, working capital increases, you will deduct, taxes, replacement capital expenditure, you will deduct. Simply, this is NPV calculation. Then you will determine the present value of future cash flows. Last examination, it was given, you have to determine net cash flow and net cash flow basis valuation, and you are need to determine what is the value, and based on that, need to determine whether this is suitable investment or not, right? Therefore, that's a free cash flow basis valuation regularly being tested. You can look on that one as well. You have to get an idea about how to deal with free cash flow basis valuation. Generally, what will be given, you will be given the forecast and it will be included some non-cash items. You have to adjust those non-cash items to get the cash flow. And based on that amount, you have to work out then terminal value calculation, and complete project appraisal will be there, right? Then you can do that one. Okay, then I am going to deal with strategic risk or common risks which we need to discuss. And I'm relating this information with the pre-scene, wherever some situation which applicable, then you can work out, you can write it down wherever it required, then you can I will give some idea on that. Then once you determine the enterprise value, yeah, I have already explained, then we will move to then, otherwise time will not be sufficient. Strategic risk. Strategic risk, the decision which you made on the selling price or acquisition, mergers, or those decisions, those are some strategy execution. Those decisions may involve a significant risk of it is affected to the growth of the organization. It includes significant cash flows, though it will affect the significant fluctuation of the entity's cash flow, and the future direction also will be affected. Therefore, it is very important to identify these strategic risk and make the decision based on the market conditions. As an example, there is a strategic risk. If you are going to acquire mill frostbite bath, then you have a strategic risk, right? Why that strategic risk I am telling? Because that entity is in a financial distress. And if you have read, I will go to that piece in that section also. Then I will highlight what are the implications and what are the areas you need to look at. Therefore, the managing director, she is very dominant and she has passed the ball to MB, and she has very dominant and she has demanding terms and condition in the acquisition arrangement also. And Frostbite Bath, it is ice cream company. Now you need to see, it is a related diversification, but you need to see whether are there any good market opportunities exist. The reason is, now people in the industry, they have suffered serious financial losses. whether they will continue and whether do they have, since management is not changing much and you can't influence to the current managing director, that means same trend will be continued. Number two, you can look at about the ice cream industry. They are, there's huge health concerns about the ice cream, not ice cream, because non-communicable disease NCDs. The diabetics patients are increasing. Therefore, population got aged. Age population is increasing. Therefore, the product like ice cream, their demand is declining. It won't increase. Then see, there's a serious issue in that kind of product, and you may not success in that market. It's a kind of a declining market that you need to evaluate. That when you are making such decision, acquisition decision, it has to be properly evaluated. Otherwise, your focus will be lost and you may face serious operate issues when you running your business. That we have to evaluate. That is kind of strategic risk which you need to identify and you have to evaluate and you have to take mitigation action. In the risk assessment, risk management, you have to identify the potential risk in the industry and you need to evaluate. Okay, while come to the milk bloom, I will explain that part. In the strategic risk also, I have explained that expect when you're going to make such kind of merger, acquisition, and exit strategies, you need to evaluate the impact on that. Then operational risk. In the operational risk involves some internal control failure or internal inadequacies there. Then quality control failure, you might have seen milk bloom plus there was a quality control failure. That's an operational issue. Then it will come to the compliance risk as well, right? Then if you have not properly managed the operation, if you are not going the proper quality control procedure, poor quality product will damage your reputation. Then you have to identify operation issues where it can go wrong. Because this industry, dairy industry, you are providing there are different questions asking valuation of frostbite. If she keep the control, but if you take 53.2% stake, you are the controlling stakeholder. Then if she is not willing to, there's some issues, operational issues are there. If you accept, if you purchase this entity, then she will give you a mandatory offer and she might quit from the operation. Because you can't do the downward adjustment. You have given the proposal and purchase consideration already be determined. Then you need to decide and criticize whether that purchase consideration is reasonable or not, and whether you are going to accept or decline that offer. Right. Then operational risk will be their business interruptions, failures and inefficient information technology system, non-compliance with regulation or internal control procedure. Some frauds can happen, right? There might be damage of the reputation as a result of operation failure. Supply chain disruptions can be happen because due to the flood. Bangladesh is a country where regularly they are experiencing flooding situation. Then definitely there will be supply chain disruption. Then how it should be managed. Those operational risks need to be addressed properly. And when you're going to manage those operational risks, you have to think about what are the mitigating actions as well, right? You have to identify the specific risk operational risk relating to milk bloom PLC or dairy industry. Financial risk. There might be risk of financing arrangement. Sometimes in this company, they have already borrowed funds are there around 23 billion or 27 billion borrowings are there, right? They have taken a bond worth of issued the bond and worth of 20 billion and they have raised the funds. Therefore, it is very important whether they have already utilized the available capacity based on the given information. Company is not highly leveraged. They have not highly borrowed funds. Company is generating reasonable profit. That is a good sign. Therefore, we have to see whether companies heavily depend on the borrowing. No. Then you have still, if the operation is decreasing, performance are declining, the current capital structure may be suitable to operate without increasing the debt component. If you increase the debt component, what will happen? When the operations are declining, if the performance are declining, you may face some difficulty to repay the debts, and most of the profit you have to pay for the debts. Therefore, you will face some trouble. When companies performing well and profit are increasing, in order to maximize the shareholders' wealth, then it is better to borrow funds and do the business. Right. Then excessive short-term fundings, you have to see whether short-term funding, short-term liabilities are high or low. And if the more borrowings are short-term, then you are facing some liquidity consideration. Therefore, you need to properly manage those. And liquidity risk, it is very important. If you look at about the liquidity risk, that mean net current liability situation will be there. Sometime operation might be disrupted due to the financial risk. Now you have to look at about, based on the only available financial information, is a bond issue mean they have borrowed funds. So bond mean kind of a debenture issue. They have borrowed 20 billion. It is given in the pre-scene. That means they have the borrowed funds, right? They have borrowed funds. It is a kind of financing arrangement. Then you have to see what is the debt to equity ratio. You have to see whether the company is geared or not, whether they can further borrow at which rate. Also, you have to decide. Liquidity risk, if you look at about this company Milk Bloom, they are maintaining good liquidity position. If current asset current ratio, it is more than 2 times, around 2.8 will be the current. You can work it out. Current asset divided by current liability. Quick ratio also high. And the cash flow risk, you have to see whether receivables, variability of the cash flows will it impact to the operations. But based on the information given there, we can't see any variability in cash flows. I didn't see that. Right. You have to look about those information in detail and see whether there are any cash flow risks. It is when you sell on credit, sometimes retail wholesalers, you might have to, Milk Bloom has to sell on credit terms, and then you have to see how to recover them, and are there any way vary, because if you sell on credit, it has a finance cost, because if you sell on cash basis, you can collect the money and you can pay your suppliers and you can run the operation smoothly, and you need not to borrow more. But if you sell on credit, then you have to finance that working capital through the borrowings. That's why it has a opportunity cost if you sell on credit, right? Therefore, it is need to establish proper credit management when you sell on credit, right? When we see the balance sheet, we can discuss some point and it will be helpful for you. Market risk, anyway, we are discussing market, possible market price or rates, market, because we are operating in yes, when we discussing the balance sheet, we will discuss, because generally the receivables will not be recognized in non-current assets. If you are recognizing it non-current asset, means sometime in order to avoid bad debt write-off, you have classify them into a long-term receivable. Kind of implications are there. That we need to discuss. There are more concern, governance concerns are there. I will highlight those areas. You can get an idea, because within this given limited time period, I am trying to give my maximum. Guys, sorry, I am little bit fast. I am not taking much. Uh, uh, if I say my processing speed is very high, a little bit high. because I need to cover up all the areas. That's why I'm telling quickly explaining, because I am answering few questions, because within the given time period I need to go through each and every section. Then you need to give an overall idea, because you should not afraid, because this is the final hurdle, right? If you pass this examination, you become a chartered accountant, because this is the final examination. Therefore, we need to work not very hard, work smart. You need to think. I'm telling you, don't think about anything else. You might have work, forget it. You have to focus on this till 6th. You have time. You have to focus on these studies, and you can write down your own notes while I'm telling some facts I'm telling, and you can, if you possible, you can work hypothetically assume this kind of scenario, if this kind of question being tested, how I'm going to write it as a report. Because the some examination, they asked to write a report to the board of director. Now, some way to possible ways to ask the question I will explain. Then you can get an idea, because I need to give whoever participate this session need to give you the clearer idea and have a clear mind and go to the exam and do your task. You have to score 40 out of 80. Then you can easily work out. You can easily do that. Do some mock exams, do some mock papers available. Do some. Oh, if you don't have, you can hypothetically assume this kind of incident happened. How I am going to write a report to the board of directors. I will give some hypothetical scenario. You can work out, because writing is essential. That is very important. We have already identified writing the examination, and you have to practice questions. Now you can't go past do the past papers, but similar kind of structure you can relate to your pre-scene, and you have to write. If this kind of a paper came, how I am going to write. Right. Now I will look at the market risk. When it comes to again, I will discuss in detail. In this market risk mean the possible changes market price, so it include interest rate change, exchange rate changes. In addition, market risk also involved in operational context. It's a business risk. You are operating highly competitive environment. Milk Bloom operating highly competitive environment. They are the second largest milk producer, but market is highly competitive. Therefore, we need to see some implication. Therefore, you have to compete on prices. You have to compete on quality. Therefore, huge competition, tough competition will be there in the market that need to be taken care of. Yes. Actually, this is I'm getting more much calls, and anyway, it is great privilege if I able to help you all. I know the feeling once you become a CM chartered accountant. You will be flying when you get the result. If you have passed the exam, then you may share the details with me. I will share. If you want any assistance, we will help you, because we need to help you all. You need to pass this exam anyhow, because we are need of chartered accountants, right? And on the for the Sri Lanka, not only Sri Lanka, in global opportunities also there. I'm not restricted to the chartered accountant in Sri Lanka. You are a global chartered accountant. You can work anywhere, get the title. When you're being a chartered accountant, you would huge lot of potential will be opened, and you will be get more opportunities than a student. Therefore, better, this is the final hurdle. Make the full effort, and we'll do this one. Then exchange rate changes, commodity price, and exchange rate changes also will affect in the milk bloom. If they are importing some product, ingredients to the production, manufacturing, those will impact. The exchange rate fluctuation also affect to the input prices. Then when they have export the product into other countries, exchange rate fluctuation in those countries also get affected, and exchange rate restriction, exchange uh, controls also affect to the operation that milk bloom need to be considered, because if they are exporting product different territory, right? Now, I will move to Milk Bloom PLC. Uh, If in 570 plus days is it retail customer, it won't be retail customers. Definitely, they are not dealing with retail customers. They are wholesale customers. Right. Okay, background of Milk Bloom PLC, I will give a rough idea. You already read this one. Milk Bloom is the largest, second largest dairy manufacturer in Bangladesh, and they have offered wide range of high quality product. And Milk Bloom, the second largest. That means top three players gaining 80% market share. Out of that, you can remember Milkvita earning 50% market share, which is government supported organization. Then remaining 30% share between Milk Bloom and other player, right? Around, as I can remember. But we don't know at which percentage. It might be 2010, it might be 1614, but we know that Milk Bloom own more than 15% because they are the second largest dairy manufacturer. Then all three players earn 80, then definitely Milk Bloom earn more than 15%. And the operation, how it has been run the operation, and Fastly Bloom, that is second generation, he's the chairman and executive director. He's the run the company at the moment. And Milk Bloom Plus, which subsequently they have introduced a new infant product, and it has caused trouble. You can remember, due to the error in production, due to the error used in formula during the production, created some allergics to the infants, and then some bad publicity has happened. Then what they have recalled the product. You can remember what has happened to Fonterra due to the melamine issue. It was widely criticized, and people were reluctant to purchase. If that kind of situation happened, then definitely it has a bad image. What they have done, company has established separate entity for Milk Bloom Plus. You can remember they have generate annual revenue of 600 million Bangladesh taka and 120 million they have spent on advertising. Right, those information was there because they failed to establish proper quality control measures. That's why this was happened. Then this is an indication there are some lapses in their internal operation, right? We have to identify that risk as well. Then there's a acquisition proposal in Frostbite Bath. It is ice cream manufacturing company which was very well reputed, but subsequently they have, due to the COVID-19 and subsequent development in the market, they are declining their market share, and they are incurring significant losses that we need to keep in mind. And the offer they haven't made an offer of 260 million in cash, and they are willing to issue 3.28 million MB shares at a discount price because they are offering at 25 rupees per share, but the market price is 49 rupees, sorry, not 49.5 BDT. That means lower than the market price they are offering the share. Right, price for the acquisition of 49% of Frostbite Bar, 49%. And remember, in addition, there was an additional market offer from Baskin Robbins, 500 million at a rate of 60% stake for 500 million. Then you can look at, there is an open market offer, 500 divided by 60%. Then it is a market, their valuation will be 833 million. Right. Then we have to work out this given situation and see how are you going to value that one. That offer is given some directors. One of the director has reluctant to go ahead with this offer, and this offer accepted by Fastly. And but one of the directors said that it strictly said this is high. This offer, this arrangement should not be considered and should not go ahead with this arrangement. Why they are saying that? This company, we'll come to the Prosperite Bar, we will discuss in detail. This company is in a financial distress. On the other hand, you have look at about the industry. Even though it is dairy, they are producing ice creams. There are some health concerns. People are more health conscious these days. Then, if the community concerned about these diabetics and all and non-communicable diseases, they may reluctant to go ahead with these kind of products. Less demand will be relatively low. It is demand is declining, and if they are earning losses and dictating terms of the managing director, those are some unconditional or those are some conditional arrangement which is restricted to operate freely. Then you need to critically evaluate the given offer whether this is a suitable or not. Sometimes you might have to justify why you are saying this offer should not be accepted, right? Yes, their PE is not compared properly because normal cost, normal market transaction, it offer range of 6 to 9.5. Here they said that it is 10 times, right? Then acquisition of 49%. Thereafter, they are acquiring another 9% total, 9 enlarged issue. They are acquiring 9% which include 53.2. Their share ownership will go up, but they are paying 60 million Bangladesh taka. Is it reasonable to pay 60 million to acquire 9%? That you need to critically evaluate, is this reasonable, the paying of this, but this amount is reasonable or not, right? In addition, you are sharing the company MD's shares also, you are giving at a concessionary price to other company, Frostbite, because they have the cash flow problem and they have some operational issues, and then as I say, you don't have any financial capacity. Also, you want to dictate. Now, if you look at the first bright bulb, they are suffering continuously. They are going to sunk, right? Now, since they don't have any option, but they are demanding, can they do that, right? Why we need to accept that offer? You need to critically evaluate those conditions while looking at financial consideration, and the non-financial consideration also need to consider when evaluating that option. Enlarged share issue means they are issuing, that means number of share issue will be increasing. It is not a right issue, it is an additional share issue they are issuing, enlarged issue. Then they have mentioned about use of smart technologies. They have invested in MB Cow project. That is some indication about use of, because recently you have done your assignment in application of smart technology in agriculture, thereafter energy and tourism sector. Because the era which we are discussing about, no, most of the time about machine learning and robotic process automation, blockchain, those new concepts big data we are discussing. Then it is very important this precision animal husbandry or precision livestock farming. Therefore, you have to evaluate those technological implication when it comes to application, because if they are part of your syllabus, the new application of industry 4.0 technology, into the modern environment, you need to get an idea about those technologies. And very importantly, most of the places they have given more emphasis on sustainability, since we are in the process of application of these new sustainability standards. And these days sustainability or ESG reporting is a widely discussed topic. Therefore there can be some application or ESG reporting requirement or sustainability approach in business operation need to be considered, and MB need to evaluate that. Right. Now you can look at Milk Bloom financials. If you look at about Milk Bloom financial, you can see the share price movement, and recently it has gone up 46, 48, 49 and 50. The share price range is given because already market available information is already there, right? You can see how their performance are look like. When we are going to value the entity, market price per share and net book value of share, you can compare and see. You can see the revenue when it comes to P&L. We will look and extract revenue. 30 million went up to 62 million within 4 years. And revenue 30 million went up 49 million by 60% increase in revenue. Then 49 went up 50, minor increase. 50 went up 62.9 billion, right? These are given in million. But profit after tax, has it gone up? No. 3.4 billion, 3.2 billion, 7.8 billion. Abnormal because your turnover has increased only by 1 billion, but profit increased by 3.6 billion, mainly due to the tax adjustment. When we come there, we can look at that one. Is 24 financial data audited or not? It is not being provided. Right. Then total asset, you can see total asset has improved 41 billion, 62 billion, and 101 billion, and 106 billion is the total asset. Shareholder equity also, you can see shareholder equity 19 billion, 24, 61, 63 billion. That's how it has gone up, right? Yep. Some students have provided one up 23, 24. Yes, ළමයි 34 year ended 31st March කියලා කියන්නේ. That is 23, 24. He is not December financial. Audited or not, I don't know. Because it has not been provided. Because we have to restrict for the information already been provided, no? It is not being provided. Okay, right. We will look at the revenue and look at the cost of sales. You can work out what is the GP margin, gross profit margin. Here, 8,000 for 30 billion. 8 billion for 30 billion revenue. If you look at about 8 divided by 30, approximately you have earned about 27 billion, sorry, 27%. GP ratio was in 2020. Lamai, if it is estimated figure, they will make it estimated. At least you don't know how to look at the financials. Now, if it is estimated, it will be mentioned. Now, still financials being given, if it is estimated, it will be mentioned it is estimated. You need not to worry about that, right? Now, look at these financial I have taken. Okay, I will go back to the financials. Right. Has it mentioned it is estimated? Nothing. Then 23, that means 31st March 2023. Has it mentioned estimate? No, this is a listed company, guys. If it is estimated figure, it's mentioned. But they haven't mentioned anything about here. Right. Okay. When it comes to some information, I will discuss it. You can look at this information. There's no any information because I don't have any information. And you can read because it is not especially mentioned about whether these figures are audited or not. Generally, figures will be given in audited form because it's a listed company. And you can look at the GP ratios which I have explained in 2021. It is 27%, 26.6. If you look at about 2024, 14.9 mean it is 15 billion divided by 63 billion. It is around 24 billion, 24%. What has happened? GP has reduced 27 to 24. Yeah. 26, 27. This GP ratio has declined. What can be the situation? What can be the reason? Potential reasons. Your revenue might have gone up. Once point, you might have reduced the price a little in order to compete, but the cost structure will remain same. Or revenue has grown up at a higher percentage, cost of sales also grown up, rather increasing revenue. Yes, increasing cost of sales compared to increasing revenue. Now you can see here 50 to 60, 60, it is 13 billion, your turnover has gone up 13 billion. But cost of sales gone up from 36 to 48, close to 12 billion. Almost same amount, it has gone up. That means increased sales have a less margin. The growth, that means low profitable product sale might have gone up. That's why your cost of sales also gone up a higher percentage. Your margin has increased by a small percentage. Margin has gone up by 1,300 million. Right. Revenue has gone up by 15 billion. Out of that revenue, gross profit gone up by 1.3 billion. Right. Then, yes, they have issued 2023 annual report, and the probably number will be audited, but not the material for us. Yes. Whether it's audited or not. There might be some additional information which will be given. Those governance related information and others, sometimes there might be fraudulent activity or sometimes misstatement carried in financial statement. It can be given in the unseen, right? Then other income also there, selling and distribution expenses, it's gone up by a significant percentage. There might be situation they might have carried out significant advertising campaign in order to survive in the tough competition, right? In addition, you can remember they have experienced negative impact on these Bloom product. There might be some additional negative covenants. In order to avoid that, they might have to aggressively do the advertising campaign. Now you can look at the operating profit is less, very minimal. It has been reduced. If you look at about 2023, we'll look at 2021, 30 billion turnover, you have operating profit 4.2. You have 49 billion turnover, operating profit 7.7 billion, right? You have a revenue of 50 billion, operating profit 7.5 billion, right? 2024, you have 62.9 billion, that means almost 63 billion. Your operating profit is 6.364 billion, lower than 2023. There's a significant decline in the operating profit, even though revenue has increased, right? If a reduction market price has increased, even there is an issue with infant bond. Right. Market price might be increased sometime. They might have potential implication of a new share issue. Sometime the price might have gone up with the investor expectation of paying more dividends in future. Or that's why I said that there's the relationship between market price and book value sometimes much different. There might be market manipulation also, can be, we don't know. And then you can look at about finance income and finance cost. It is reasonably okay. There's no significant amount of finance cost. It's close to 1 billion finance cost is there because they have borrowed around 20 billion from external market. And the important point is the taxation. There might be some tax default. That's why they have provided additionally. There are some changes in taxes. When your profit before tax 3.6, you are paying 179 million as a tax. Then there might have been underpaid. The next year you have paid additional tax for prior year. Additional tax for prior year. That means there might be some assessment, 2.5 billion they are provided. Then that's why their profitability has significantly reduced. Sometimes it can be, there might be some assessment in the, because since you have not paid the taxes properly. But next year, there is a significant reversal. There is a concern why these significant changes in your income tax provision and reversals. That is a concern. That is a matter of concern. There's a significant doubt on those adjustment taxation, because they might have expected, as you've seen, they have not properly paid tax. That's why they have made a significant tax provision. They expect that they might have to pay a penalty. Subsequently, assume, I'm thinking a scenario, they might expect, yes, they have to pay a penalty, and with the taxation, that's why they have allocate a significant tax amount they have provided. But they have reversed around 1 billion, they have reversed that. And same year, 2023 also, even though they have a taxable profit before tax is 6.5 billion, there might be, due to the deferred tax arrangement, there's a positive 239 million. It is add back, not a deduction. Total tax credit there in 2023, it is 1.28 billion. Due to this abnormality, in order to evaluate their performance, profit after tax may not give the clear picture due to this tax arrangement. Yes, in order to normalize this scenario, if you want to evaluate their financial performance, I would like to recommend use the profit before tax as the measure to evaluate their performance. It will give you a clear picture. Profit before tax. Even if you take operating profit, that will be great. EBITDA, EBIT, earning before interest and tax. Then you can give a clear opinion on the performance. Yes, you are operating results. If you work out, then you can get a clear idea whether your performance has improved or reduced whatsoever. 12%, 14%, 3%, and 8%. There's a significant issue in this arrangement. There's a significant concern you need to keep eye on because their profitability 4.2 billion for 30 billion revenue, then 7.7 billion for 49 billion revenue, 1.5 billion for 50 billion, but 6.36 billion for 63 billion revenue. Then this is a serious issue which you need to take care of, which you need to look at. There's a serious issue in the operational arrangement that need to consider. No, when you're going to calculate, because it is operational issue, in plan formula or additional charges and penalty, because that is arise as a due to the operational arrangement. Those are part of the operational cost. You have to take care of that one because that need to be evaluated. That is a part of operational failure that need to be counted and work out why those significant reduction in profit and reasons need to be find out. Right. Therefore, your profit has declined over the period. It need to be assessed properly. And the profit, if you take out 2023, it is significant increase from 3,282 to 7,800. There's a one adjustment. They are due to the income tax adjustment. Otherwise, if you look at PBIT, it more or less same. Little bit marginal decline you can see. If you look at about statement of financial position, property, plant, and equipment is a significant part in the operation. Investment in marketable security, guys. Investment in marketable security generally, we are taking the acquire those marketable securities for the trading purpose. Then it should not be categorized as non-current assets. Generally, it fall under current assets. If they are marketable security, when the cash deficit or cash requirement arise, you can sell it and get the cash. Marketable securities like you can invest in stock market, share market, and whenever you require, you can sell those shares in the market and you can realize the value. Then biological asset also there, you will, if you have were heard and you need value those farm, those biological assets and need to take a fair value of the asset need to be uh, taken into the balance sheet. Intangible asset, there this intangible asset, they have mentioned that this intangible asset include uh, water use right, that's a patent right, and you will do market valuation and software also there's some additional explanation on that. Uh, Trade and other receivable, this information one student has raised the question, can you recognize trade and other receivables into non-current assets? This amount might not have been received during the period. That mean they have received reclassified in non-current asset because it is a long-term receivable, or sometime it might be a deposit, long-term deposit, right? But general trade and other receivables will not be classified into non-current asset. That is another concern. Inventories, it is went up to 11.8 billion to 17 billion because you can't keep huge inventory because inventory has increased by 50%. That you have to see why it has been increased. There might be some implication due to that recent milk bloom plus issue. There might be some inventories which customers are not willing to purchase. Customer refusal. Those inventories might be there in the inventory. That's a risk you need to understand. Therefore, there might be some impairment. Inventory written offs might be there, right? You have to clearly understand that one, that's high risk involved for that one. That is a high risk one. I'll say. This one, inventory. Right. 11.8 billion to 17.3. There might be some inventory related risk. Therefore, you have to focus on that one. There is a risk associated with this amount because there might be some withdrawals. You have it has been mentioned that company has to withdraw some milk bloom plus in the market. Those inventories might be there in this inventory that need to be written off, but they might have not written off those inventory while keeping the inventory in the balance sheet. That is an indication which you need to consider. And trade and other receivable also, they are 10 billion to 13 billion. It's a 30% increase. And one student asked about deferred tax asset. Deferred tax asset can arise as a carried forward tax losses. Sometimes employment benefit, you can have a deferred tax asset. It is a very normal amount, 767, right? It depends on the situation. Current tax assets, sometimes recoverable assets is there. Derivative finance, small amount, those are minor amount. Other investment. What are these other investments? 28 billion reduced to 15 billion. Part of the investment has been released. How you are going to value this investment? Whether they are mark-to-market investment, whether they are carried out cost, what kind of investment this is? 15.5 billion. Then that needs to be taken care of, and what kind of investment, whether this is a short-term investment, if there's a long-term investment, what is the valuation method? There might be some other, because there's some issue because significant amount being invested in other investment. It has not been mentioned, right? Cash and cash equivalent, they are maintaining a reasonable cash and cash equivalent. Now you can see share capital marginally changed. Earlier it was 38 billion, 38.06, but it went to 38.107. There should be share issue, minor share issue around 47 million, right? Revenue reserves there, other reserves also there. Loans and borrowings, 24 billion, right? This include this is a long-term portion, short-term portion, they're 9.2 billion altogether, 33 billion. Therefore, the borrowing. Lease liabilities are there because lease asset or ROU asset also you have recognized, and ROU liability there. And deferred tax liability also arise. They have recognized asset and liability separately. And this deferred income, I don't understand why this deferred income same in last year and this year as well. There's a doubt on that part. Because if it's a deferred income, at least it need to be charged to P&L, or why it has been recognized as a deferred income. Same amount for 2 periods. That is a concern. Then trade and other payable there, and derivative financial liabilities. That's okay. Short term and long term portion, they have it. What you can do, you can work out some ratio. What are the ratios you can work out? You can work out gearing ratio. You can work out current ratio. You can work out uh, quick ratio, and you can see how is the gearing looks like, whether it has been improved or debt to equity ratio. You can work out and see, right? Then 20 million bond I couldn't find. That means, Buddha, you haven't read it properly. Because if you have read, you should have been found it out. Hope you can see. Borrowings. You all have to read this properly, guys. Look at this one. You all are not reading it properly. Borrowing include bonds issued on 19 May 2021. In that terms, they are bond mean debenture. 20 billion on bonds with a maturity date of 2020 at a coupon rate of 12% per annum and payable semi-annually. That is the borrowing. That you need to keep in mind. Better you read properly and prepare for the exam. Right. When we are calculating operating profit, finance income should be added. No need to add it. Operating income exclude finance income. Operation, while you are running the operation, revenue, cost of sales, then gross profit, then you need to adapt operational expenses. Right. Key risk in dairy industry, market risk is there because you are operating in a highly competitive environment. Price pressure will be there, inflationary measures risk will be there. Then you have to supply side and demand side constraint you need to manage properly. Therefore, there are few marketplace are there, wide variety of products are there. Customer preference can be changed. Then you have a high competition. You need to face on high quality product should be offered at a lower price or competitive price. Competitors also offer different range of product varieties. You need to compete on that. Then inflationary pressure also effect on consumer purchasing power. In addition, change in customer preference need to be captured in advance in order to get the market face the market risk. Then supply chain risk in suppliers supply will be interrupted due to natural disasters or sometimes suppliers you might have lost the supply and they might have joined with the competitors. Therefore, you have to manage supply chain properly and ensure that continuous supply of quality inputs to the production. And regulatory and compliance risk, you need to comply with so much of regulation because this is health and this is related to food processing. Therefore, it is mandatory to comply with rules and regulation and quality control measures. It is better to have a separate legal and regulatory department into measure and see the compliance requirement. Compliance audit need to be conducted. Environmental risk, because you are disposing waste and it has to be properly disposed and there will be greenhouse gas emission will be there. You need to minimize those effects when you run the operation, right? Animal health and welfare is because animal health is very important to get a higher yield and quality output. If the animal is not properly here, if you can't have a good healthy herd, then you may not be able to get the quality output. Therefore, it is very important animal health and it need to be properly monitored. That's why you have used the milk MB cow project to monitor behavior of the cows and their health. Then you can do the precision livestock can be managed. Technological risk, because environment is rapidly changing and technological development will be there. You have to adapt new technologies and can you remember in Bangladesh earlier the yield per cow was 2 liters per day. Now it has increased up to 4.5 liters a day. Right. Then new technologies, new product you need to launch. If you are not launching new product and new yielding arrangement, then you may not be able to sustain in the market. Climate changes associated risk. Definitely climate changes will impact on the operation. If those climate changes, bad weather patterns and climate changes adversely affect on the operation. As an example, assume flood. Flood will disrupt the operation, and this operation of the dairy farms, their greenhouse gas emission is little bit high. Then how we are going to manage those one, right? Reputational risk, which we have already identified in the Milk Bloom Plus, if we have not uh, maintained not properly maintain quality control, there will be reputational risk. If there's an report published, companies are not following proper regulations, and there is an issue with quality measures, definitely company has to discontinue, or company's operation will be failed, right? And reputation is very much vital in this aspect. Consumers are more concerned because they are a full keep the full trust on the product. If they lost the trust, regaining of the trust will be very difficult. That is you need to keep in mind. Bloom trust issue, that's why they have decided to create a separate entity. And exchange rate risk also there. Now the exchange rate risk, sometimes you, even though you don't have a subsidiary in overseas, sometimes you might have export the product. There might be some receivables. Then though if there's those receivables are there, the fluctuation of exchange rate, you need to adjust, right? That's why some student asked that why there's a inflationary, sorry, in the exchange rate fluctuation differences being taken into the PNL. Mainly, it is due to the fluctuation of there's no additional information. They are running a uh, separate subsidiary in overseas. They might export the product because there are some additional information that they have initially export the product to Sri Lanka as well. Then it was not then that project was abandoned, right? Uh, then I have touched sustainability aspect, sustainability in dairy industry, because this will be helpful for you as well when you run the operation. We have look at about environment, society, and governance. We need to comply those aspects. Therefore, if you evaluate based on environment, society, and governance in sustainability aspect, you have to properly use, because this is energy will be used, water will be used, and feed, and you have to proper efficient utilization of energy, feed, and water is required. On the other hand, there's a wastage, and you have to dispose those waste without damaging to the environment. That is a environmental aspect. You have to do that one. Implementing practices to reduce methane emission from cattle, such as improved feeding practices and manure management. Therefore, there's a carbon emissions and methane emissions there in the cattle. Therefore, you need to uh, properly monitor, and those environmental aspects need to be properly catered. Investing in renewable energy sources like solar and wind power for dairy operation, because these Milk Bloom, they have invested in renewable energy. That is a good sign. You can see a positive sign in their ESG or sustainability approach. Sorry. Utilizing waste products as such as converting manure into biogas or organic fertilizers. Therefore, we can go makilakan in where those you can use to manure or biogas or you can do organic fertilizer. Those days, these organic fertilizers were very popular, right? You can remember those days. Uh, ensure fair pricing and stable income for dairy farmers to maintain economic sustainability of the supply chain. That the societal aspect, because in the values of Milk Bloom Plus also they have mentioned the value, four pillars of values they have mentioned in the cooperative strategy. Out of that, fair pricing is one of their values. Therefore, they are addressing that social aspect as well. They are proper or fair pricing for all the farmers in the supply chain. Ensuring high stand for animal welfare to improve productivity to meet consumer expectations. That is also good because that's why they have started milk no, the MB cow project to monitor uh, animal health and welfare and animal health and increase the productivity. And supporting local communities through job creation, education programs, and infrastructure development. You can see that social aspect as well. They have given the support to start some organic farming, organic farms, right? And uh, the community development project also, there were some incidents. They have supported farmers when they are we required some needs and CSR project they have carried out, and so many welfare projects they have carried out. That's a good sign. Providing fair wages, safe working condition, and opportunity for professional development for employees. Bangladesh is a country, the more criticism came from child labor usage. Now they have to apply those restrictions or avoid that labor policy need to be properly disclosed. Child labor mostly used in uh, proper sustainable approach. One says that they have mentioned that one student has mentioned that they have spent much on CSR, then it is high cost. No, guys, when you do when you do more community engagement, you can create the trust. Through the trust, and it will create some additional benefit and long lasting relation because you are selling the product to the community. If you have more community engagement and if you are very popular among them, then it automatically bring you some sustainable, your brand name will be established in the society, right? Which way, how to use sustainable practices in dairy industry can be asked, and you need to critically evaluate whether their commitment to implement their stewardship towards the implement sustainability practices. And you might ask for how to use ESG practices and ESG performance criteria, and how are you going to measure the performance in ESG, right? If you want to run the sustainable operation in dairy industry or milk bloom, what kind of policy you may recommend, what kind of uh, improvement, what kind of activities you may recommend. Sometimes you may ask, criticize on the sustainable practices in dairy industry, in milk bloom, dairy industry or milk bloom PLC. That kind of question might ask. Anyway, the sustainability approach, I feel they might look at about the sustainability here and there overall aspect. It has been discussed more on detail about the sustainability. Therefore, you need to uh, look at on sustainability aspect. Better to read the newly issued sustainability standard S1 and S2 to get an idea about application of sustainability standards. S1 and S2 better you can. Obtaining certificates such as organic, fair trade, or animal welfare certification demonstrate commitment to sustainability. You can see there are some commitment example. You can see they have given organic farming practices being promoted among the farmers. Then you can look at that one as well. Working closely with suppliers to entrust sustainable practice throughout the supply chain. That's why they have given more training to farmers and for the yielding and milk processing, and they have implement more sustainable training practices and sustainable farming practices also been introduced. Implement a system to recycle water use in dairy operation, reducing overall water consumption that you can do. Those are the sustainability aspect in dairy industry. I'm a little bit faster. Uh, and so much of area I have covered already. Prior to that, I need to highlight some aspect in I think about this one as well. In none of the other lectures will not be covered, webinars will not be covered. Some aspect in corporate governance, right? I will go to some aspect in corporate governance we need to consider, right? Right. Now, if you look at about the directors in board of directors in Milkbloom PLC, it's a listed company. Now, in this explanation, let me extend my heartfelt thanks to all our stakeholders for accepting MB as your life partner. I am thankful to executive directors Ahmad Khan, Hassan Mahmood, Omar Ibrahim, Muhammad Ali, and Aisha Malik. You can see Ahmad Khan 1, Hassan Mahmood 2, Omar Ibrahim 3, Muhammad Ali 4, Aisha Malik 5, and Chairman also there. Firstly, Bloom is the chairman, then 6 directors, the board, and independent director means refined out. The CEO Fatima and CEO Fatima Daud. Remember, in the explanation it says this is a serious issue. The chief executive of the Fatima Daud and Rifai Daud, they are close family members. Mr. Rifai Daud is the husband of CEO Ms. Fatima Daud. How can he function as an independent director? He can't. It is a serious issue. It is a serious information which you need to look at. Right. Uh, you have to closely look at this one because independence, you can't say this is independent. What is the independent requirement? Board balance. In Bangladesh code of governance code, it says minimum board should include 5 directors. Yes, they have 7 directors, right, based on the information. Out of 7 directors, it says that 6 directors are executive director, including the executive chairman. Then independent director, also you can't consider him as an independent director. Therefore, there is no independent director. No, it's still I don't we can't say, but if you look at about corporate governance code in Bangladesh, they also say 5 directors or 2 directors or 1/3 of director, whichever is higher. Minimum 2 directors should be independent. But here, there's no independent director at all. Mr. Refined out the conflict of interest. It is a serious issue. Sometimes this governance issue might be given in detail in unseen. Can be. If I am a student, I'm thinking that like that. In Sri Lankan context, what is the governance concern? It says again 5 directors and 1/3 or 2, whichever is higher should be independent. Now there's no independent director at all. Therefore, they are non-compliant. In Bangladesh code also they have mentioned. It mentioned 5 directors should be there in the board as a minimum, 2 or 1/3 of whichever is higher. Again, that condition is not met. And the chairman should be non-executive director. That condition also they have violated. So based on the condition, probable thing, 1/3 or 2 is the minimum. Then this is an issue in relation to corporate governance because they have violated this situation, right? That you need to keep in mind governance requirement. Now you can see these are the board members. And there are 5 board members. In addition to chairman is Parsley Bloom. Parsley Bloom is the chairman. He's the son of the founder, uh, and all are executive, 6 executive directors, and there is a non-executive director, but he is not independent because he is the husband of CEO. Therefore, there's no independence at all. Therefore, no independent director in the board, and there are some audit committees and remuneration committees there in the Bangladesh court, even in Sri Lanka. That governance aspect need to be taken care of. The governance side, they have an issue. As a listed company, they have an issue. Right. Okay. Right. Those sustainability aspect also. Is any problem in chairman position? Yes. Chairman should be non-executive director, but he is an executive director. There is an issue. When appointing new chairman, also it is to see a lot of procedures need to be followed. It is not easy like you think. Right. Okay. Thank you. That's I wanted to summarize within a given time as soon as possible. I have summarized all the aspect, all the areas. I think you have get an idea. It is not a complete analysis within a given time period. I have summarized as much as possible. I have little bit faster than usual because in this area we need to discuss in detail. Risk need to be discussed in detail, and possible scenarios we need to discuss. Governance aspect we need to discuss because governance side there are some issues. Risk management side you need to identify the key risk in the industry and their implication and how to mitigate it, mitigation actions. Those areas you need to discuss. Right, guys. Throughout the 2.5 hours, we have gone through all possible areas, all required areas. We have simply gone through, and uh, this is your final examination. Therefore, you need to prepare much. While I'm going through some questions, still you don't have proper idea on the given piece in information. You need to. I will share this presentation because remember this presentation is not uh, not a comprehensive one. It's a small one. You have to do a lot. So much of things. And where they mention about non-executive director, they have mentioned, but he's an independent director. If it is an independent director, definitely he is an non-executive director, independent, and he is not involved in the operations, right? Then he will be considered as an executive director. That means he's an independent non-executive director. But problem is he is not independent since his wife is the CEO of the company. There's a conflict of interest. Because some information it is not being directly said, but you have by looking at logic, if you logically think about that, then you can understand that. Because husband and wife, they are not working in the same organization, right? It's a main independent director. Independent, then that means they are not any business relationship or not involved in the operation or not employed by the company, right? Yeah, Fastly Bloom is the chairman. Yes, Fastly Bloom is the chairman. Because Fastly Bloom we can consider as an executive chairman because he is involved in developing this Milk Bloom Plus product, and he is closely dealt with the Professor Malik, as I can remember. Yes, in examination you can just show the numbers. That is enough. No need to calculation. This is not a management accounting paper or accounting paper. You can just give the values. as you obtain. When presenting the information, when presenting the value, you can present. Sometimes they might ask to present as a report format. You will present. Sometimes they might ask write a report. Now there's an incident information. If I say about this prime row, now they are going as OV. They might be work as a consultant. You might be the consultant of that company, and you might ask to write a report to the board of director, right? Then you might have to do some appraisal. You better if you can do in the body itself, or you can do it as an annexure. The result of the calculation you can present in the body of the report. What is the normal pass rate of the case? Last time it is more than 60% pass rate was there. Give me a second. Last time. Yeah, around 63% pass rate was there. Paper is not hard if you properly go through the pre-scene, and if you properly open, you should go in open-minded, and you should read entire pre-scene. You can if I am a student, when I was writing a SL5 pre-scene, I have expected if this kind of situation come, the unseen scenario which I will predict. If this is come, how will I will answer the paper? If this kind of scenario came into the scenario, what will happen? Likewise, I have predicted and I have for different scenarios, because it was beneficial for myself to prepare for whatever the scenario. Then I have prepared, I have written because the writing of a paper, summarization is much important. Why? Uh, if I have written because this is an open book exam, you can take any material. I will show you when I was a student. If I have record, if not the full report. When I was a student, I will show you how I have prepared for my study examination. When I was a student, I have prepared a report. If there's a report, if examiner asks to write report, I have prepared. This is my table of content. I have write down the report structure. Then I have written down my own cover letter is not required. Memo, if it's an internal report. Table of content, terms of reference. This is not required, but I have written a complete report. Then I have written executive summary. This is my handwriting when I was written my case study in, I can't remember the exact year. It goes to 2015 or somewhere else. And this is how I have written an introduction, and thereafter these are some environmental analysis. This is how I have prepared by my own handwriting, and I have prepared for the worst case scenario. Because you have to write more. So those days we don't have in lengthy session like this. Physical sessions were there, but less information. Self study is the more important thing. Then yeah. Uh, If you have to answer, you have to write the report based on the marks allocation. Some situation, executive, it is special mention, executive summary is not required. If it is based on mark allocation, we have to write down the report properly. If it is not given any marks for executive summary, you need not to spend much time on that. If they said executive summary mark allocation 5 or 10 marks, then definitely you have to write the executive summary at the end of the working calculation and end of the report, because it is a summary of the entire report. If they ask, only you have to write it down. Sometime frostbite 49%, and why again 9% acquired, not acquired actually. They have proposed. They have like kind of a share sale agreement. They have signed. They have agreed in virtually. They have agreed, but it is not signed. They wanted to sometime they more wanted the controlling stake. That's why subsequently again they have acquired additional shares and increased from 49% to 53.2%. Not number of pages, the content what you written is the matters. Right. Don't think about number of pages. Look at about the time allocation, mark allocation. Based on mark allocation, you will need to allocate time accordingly. It is very important, the time allocation. I can't say for how many pages need to be written, guys. It is I can't say actually this number of pages need to be written, because it is totally you will be received 3.5 hours for writing and 30 hours. Word count no word count, guys. Right? No word count at all. Therefore, don't worry that. No word count, not like assignment. Right. Yes. Cross by 53.2 is the controlling stake. Another thing, you will have 30-minute reading time, then you have to plan the answer accordingly within 30 minutes. The remaining 3.5 hours, you have writing time. At 30 minutes, first you look at, before reading the unseen, first look at what is the requirement, right? I will give you an example. I will take a paper and show it to you. Give me a second. Right. When you're writing the paper, I am doing additional thing for you guys. Now you will receive an unseen paper like this. May 2021 paper. It says 30-minute reading time, writing time, 3.5 hours, 80 marks. Now you can see they have given the total number of pages, including front page, 8 pages. First page you can exclude. Now you can see required. Look at this one. There are 7 requirements to be addressed. And executive summary, they have given 5 marks. Now look at this situation, critically evaluate the current strategic position, that is for analysis need to be done. That requirement 1, 22 marks given. Then you need to allocate time accordingly. Evaluate the strategic options available to ABA. But evaluate the risk exposure of ABA, recommend any appropriate risk management strategies to overcome them. That means you have to look at what are the risk management, the risk what we have discussed, we have identified risk, what is the implication, how to mitigate them. You can impact analysis suggest correct action for the matters highlighted by Kamal. There might be situation, information given, some additional information you have to highlight. Advise the board of directors on available and suitable funding of funding option, acquire injection molding machinery, funding option, financing arrangement. You have to look at about the capital structure. Advise the board of directors on the investment on injection molding machinery. That means project should be done. Advise the board of directors on clarification required by Suren and transfer pricing. Transfer pricing taxation also, because it's a group of company. Look at this one. The Kamal contact a consultancy firm, ABC consultant, and provide them with summary of the requirement along with detailed explanation on the background information from earlier date. Now you need to write report, means financial performance, pricing, working capital management, discount given, production, a stakeholder analysis is given, right? Resource type, and this is the project investment. This is a capital expenditure, right? This is a capital theoretical capacity and plan capacity, and these are product information, and these are the information. You have cost of data neatly given, You have decided whether you are going ahead with debt or equity. It depends on your capital structure. Transfer pricing, applicable tax rate 14%. Right, those information, this kind of information will be provided at the unseen. Right? Out of this, most of the information, the first one, second one, uh, third one, third and fourth, more of them, that means 22, 34, 45, 57, mainly you have to extract from the pre-scene. Therefore, most of the information you can extract from the pre-scene. Other information you can relevant to most of other information relevant to financial management is given in the unseen. Right. Therefore, this is how you need to prepare for the exam, guys. You have to write more. Now you can't go the past papers. You have to imagine. You have to write down one question and you have to develop an answer for that. Writing is much important and essential because you have to manage the time within the given time period of time. 30-minute reading time, 3.5 hours reading, writing time. Right, you will be able to do that if you properly committed and properly work and properly plan your study. Then you can easily do that task. And finally, order can be changed. Yes, you can change the order. Better to follow the same order because it then you can make the flow, proper flow can be maintained, right? And finally, I will show all the best. It's a very limited time. You should be able to do that, and hopefully we will be able to meet in the annual conference to be held on October. As a member, you all will join. Uh, since we have not meet face to face, I may not recognize you, but you may recognize me. And I'm Nishant Adhikari. I'm telling at the last moment. I will share the slide and you can. I am expecting that you will be joining as a member in Sri Lanka and join to the annual conference. Right. Therefore, I will. Okay, I will share the. I have shared the. Give me a second. Need to be shared with everyone. Right. Give me a second. I am sharing the presentation. You can download the presentation. I have shared the presentation and you can download it. I have shared. Can you see it? Right, guys. Thank you very much, and you can download it. And I think I have add some value. This is not a this is small time period I have spent, and hope you have got something out of this one. And I am happy that I can share some sort of for you and you guys, and any comment on online and overseas. Yes, you have to write in online. It is not a big task, and you might receive this exam instruction. Same time period will be applied. Hope we can meet as because sometime I may contribute only for this session, and but you might have met in early studies. And finally, anyway, I want to see you all as members. Wish you all the best and see you as a member. And I think I have had some value for your final journey. Wish you all the best. I have shared the slide in the chat. Anyway, I will share these slides with Sri Lanka and they will share with you. Thank you guys and have a nice day and properly spend you in your these days because it is exam is approaching. Wish you all the best. Thank you very much for joining and wish you all the best for future chartered accountant. Thank you. Thank you, everyone.